Welcome back to Talk Tickers. This is the show where we try to strip away all the corporate fluff and get right to the numbers that are actually moving things.
That is the mission. We take the transcript, we take the press release, the market reaction, and we try to synthesize it all into, well, something you can actually use.
Today, we are trading our sights on a regional bank that is, let's say it's baffling the street right now. Associated Banc Corp, ticker ASB. They just dropped their Q4 2025 results. And I have to say, this is one of the most interesting disconnects we've seen all season.
It really is. It's a classic case of, good news is bad news. Or maybe it's more, good news just isn't good enough, given all the anxiety out there.
Exactly. So let's just set the stage. On paper, this quarter, it looked like a victory lap. I mean, management called 2025 a pivotal year.
A pivotal year, right.
They beat on earnings per share. They beat on revenue. They posted the highest net interest income in the history of the company. It looked perfect.
And yet the market was not impressed. Not at all.
Not even a little. The stock dipped, about 0.8% right after hours. And then the next day, it just fell off a cliff, a drop of nearly 3.75%.
And that drop matters. The volume is really heavy, something like 1.6 times the normal average. But what really caught my eye was the positioning going into the print.
Oh, this is interesting.
Yeah, short interest had jumped about 20% in the last 2 weeks of December. So this wasn't just a reaction. There was already a crowd betting against this thing before the numbers even hit the wire.
So that's our mission for this deep dive. We have to figure out why the street is selling what looks like a fundamental beat. Is this pivot real, or are the skeptics right? Let's start with the snapshot. What were the headline numbers?
Sure. So bottom line, GAAP EPS came in at 0.80 cents. The street consensus was sitting around 0.72 cents.
So in 0.8 cent beat, that's what, like 11%?
Yeah, an 11% beat. And in the banking world, where models are usually dialed into the penny, that is significant. That is not a rounding error.
And I assume that flowed down from a beat on the top line.
It did. Revenue was $389 million, which beat consensus by nearly $7 million. But the real story, the one management kept hammering on the call, was net interest income, NII.
Right.
It hit $310 million. That's a company record, and it's up 15% year over year.
And just to pause there for a sec, NII is everything right now. It's the raw fuel of the bank,
Yeah.
The difference between what they make on loans and what they have to pay out for deposits.
Precisely. And the efficiency of that fuel, the net interest margin, or NIM, that expanded to 3.06%. That's up 25 basis points from a year ago. A lot of banks are seeing margins get crushed right now. ASB is expanding.
And they're not just, spending like crazy to get there.
No, and that's the other key metric here, the efficiency ratio. It held steady around 55%. That tells you they're keeping expenses in check even while they're, aggressively hiring.
Okay, and the capital position, solid.
Robust. Their CET1 ratio is sitting at 10.49%. So you have a well-capitalized bank. It's growing margins, beating earnings, hitting record income.
And the stock drops almost 4%. It's a fascinating tension. It just suggests the market is looking completely past Q4 and is worried about 2026.
It's the forward-looking discount mechanism, right?
Yeah.
The market is asking, okay, great, but can you do it when the Fed cuts rates? Can you do it when the economy slows down?
Right. To understand that, we have to look at what they're actually doing with the balance sheet. Management calls it the remix, what's happening under the hood.
This is the core of their entire strategy. I mean, for years, ASB was known as this sort of conservative, maybe a little sleepy bank that was just heavy on residential mortgages.
Which are safe, but...
But the so low yield, in a world with high rates, a 3% mortgage on your books is just dead money. So the remix is this intentional plan to let those mortgages run off, and they're not replacing them.
Okay, so they take that capital and they redeploy it into what?
Commercial and industrial loans, C&I. These are loans to businesses. They're typically floating rate, and they come with a whole relationship attached.
Right. A mortgage is a transaction. A C&I loan is a relationship that brings in other business.
Exactly. And the numbers are huge. They've reduced their mortgage concentration by over 10 percentage points since 2020. In 2025 alone, they grew C&I loans by over $1.2 billion.
Wow. It's a massive rotation. You're trading a low-yield asset for a high-yield one that brings deposits. Which brings us to the other side of the remix, right? Funding.
Correct. The liability side is getting a makeover, too. They added nearly $1 billion in core customer deposits last year. That's huge.
And that lets them get rid of what people call hot money, right? Like brokered CDs and wholesale funding.
Yes, exactly. Hot money is expensive and it's flighty. If you can replace a 5% brokered CD with a 0% operating account from a business client, your margin just explodes. That is the holy grail.
So this brings us to their defensive posture. The CFO, Derek Meyer, he made a really specific point about being rate neutral. This seems critical given the fear around Fed cuts.
Oh, it's absolutely critical. The fear is that as rates drop, that beautiful margin expansion just vanishes. But Meyer was very clear. He said they are positioned so that even a down 100 basis point rate move would impact NII by less than 1%.
That is a bold claim. How are they doing that?
Derivatives and hedging. They have about $2.45 billion in received fixed swaps. It's basically insurance that pays them if rates drop. So they've built a fortress around that margin because their 2026 guidance already assumes 2 Fed cuts.
Okay, so the defense is set. Let's talk offense. This brings us to theme 2, growth like a weed.
That was a great line from the call, wasn't it?
It was. The CEO, Andy Harmening, was asked about Kansas City, and he said, if it looks like it's growing like a weed, it probably is. He clarified it's high-quality growth, not just, loose credit.
And this is the geographic expansion story. ASB is trying to break out of being just a Wisconsin and Chicago bank. They are pushing hard into the Twin Cities, Omaha, Kansas City, and now Dallas.
Everyone wants a piece of Texas. But their strategy seems very specific. They're not just opening branches.
No, that's the old way. Their strategy is boots on the ground headhunting. They are buying talent. They're hiring experienced relationship managers or RMs.
And these RMs, they bring their own book of business with them. Their Rolodex is their bank.
Exactly. And they gave specific numbers. They're adding 5 RMs in the Twin Cities, 2 in Kansas City, and 4 in Dallas this year. That is a 10% increase in RMs bank-wide.
And that connects back to the weed comment. You hire a senior RM, they bring the loans, and critically, they bring the low-cost deposits with them.
That's the talent lift model. It's faster and cheaper than buying a whole bank, but you have to execute. And they're putting money behind it, too. They're doubling their acquisition marketing spend in the Twin Cities and Omaha.
So they're not being shy. This leads us to the guidance for 2026 and the elephant in the room. That American National acquisition.
Right. Let's look at the guide first. Standalone, they are forecasting C&I loan growth of 9 to 10%.
That is an aggressive number in this economy. I mean, GDP is forecasted to be, low single digits?
It implies massive market share gains. They also guided to total loan growth of 5 to 6%, NII growth of 5.5 to 6.5%, and they claim they can do this while only growing expenses by about 3%.
That's positive operating leverage. If they hit that, the stock is dirt cheap. But that C&I number, the 9 to 10%, that's likely where the skeptics are getting hung up.
It feels optimistic. And then you layer on the complexity of the acquisition. The American National deal is supposed to close in Q2, but management was very tight-lipped.
Vague is the word.
Very vague. And in this market, vagueness gets punished. They cited regulatory approvals, which is standard, but it leaves a black box in your model, and investors hate uncertainty.
It's the show me story penalty. The market's basically saying, great quarter, but prove you can integrate a bank and grow C&I by 10% at the same time.
Exactly. Integration risk is real.
Now, usually when a bank is growing like a weed, you worry about credit, but the credit picture here seems fine.
Surprisingly fine. Net charge-offs were only 12 basis points for the full year. That is incredibly low. And criticized loans actually decreased by $165 million in Q4.
I did see some chatter about commercial real estate CRE. Payouts were elevated. Management spun that as a positive, though.
And I think that spin is actually legitimate. They said these were construction projects getting completed and moving to the permanent market. That is a healthy ecosystem, not a distressed one. It means the assets are performing.
Okay, let's recap. Credit is fine. Profitability is at a record. The balance sheet is hedged. But the stock is down. What is the bear case that drove that 3.75% drop?
I'd say the bear case is a 3-legged stool. 1, macro skepticism. Investors just don't fully believe the rate neutral story. 2, integration risk with the acquisition. And 3, that 10% C&I growth target just feels like a best case scenario that probably won't happen if the economy slows.
And the high short interest suggests a lot of people are betting on that failure.
They are.
Okay, so flip it. What's the bull case?
The bull case is that this remix is structural, not cyclical. They are permanently fixing the balance sheet. If they execute on hiring in Dallas and Omaha, they're swapping into high-yield relationships while keeping a lid on expenses.
And we saw KBW raise their price target to $30 post-print. So some of the deep dive analysts believe it.
Right. If ASB pulls this off, it validates the entire relationship banking model. It means they're becoming a specialized commercial lender in high growth markets. That deserves a higher multiple.
It's a high stakes pivot for sure.
It is.
All right. That brings us to our favorite part of the show. We've looked at the past, analyzed the present. Now let's get a little speculative.
Time for the legal disclaimer.
Absolutely. This segment is for entertainment purposes only. This is not financial advice. Do not trade on this. We are just pitching wild scenarios.
You call it wild but plausible.
Exactly. And I'm calling this trade idea the heartland hustle, or maybe the RM arbitrage.
Okay, I'm listening. What's the setup?
The setup is the disconnect we just outlined. You have a market pricing and a regional bank slowdown, but you have ASB actively headhunting top talent in markets like Dallas and Omaha that are growing way faster than the national average. And you have that 20% short interest.
So you have a coiled spring.
A coiled spring. Here's the trade. You go long Associated Banc Corp, ASB, and to hedge it, you go short a coastal, mortgage-heavy regional bank index, or maybe a specific peer with high office CRE exposure.
Okay, so you're betting on divergence. You're betting geography and business mix matter more than the Fed.
I am betting on that growth like weed comment, not being hyperbole. Here's the catalyst. Q1 2026 earnings. What if those new hires in Dallas and KC start bringing over their deposit books immediately?
If they bring the deposits, they can fund all that loan growth very cheaply.
Exactly. If they show they're growing non-interest-bearing deposits because these new RMs are bringing over their clients' entire operating accounts, the net interest margin won't just hold steady. It will expand, even if the Fed cuts.
And that would catch the shorts completely off guard?
It would trigger a massive squeeze on that 20% short interest. You're betting that the personnel transfer, the actual humans moving from one bank to another, is something the trading algorithms are completely missing.
That's the arbitrage, a labor market arbitrage. You're betting the CEO's recruiting pitch is better than the market thinks. It's wild, but if those loan pipelines are actually up 43% like they claimed, it's definitely plausible.
It's the heartland hustle, grinding out growth while the coasts worry about empty office towers.
It's a compelling narrative, but again, execution risk is real. If those new RMs don't deliver, they're just stuck with higher expenses.
100%. So, to bring it all home, Associated Banc Corp delivered what looks like a pivotal quarter on paper. Record NII, solid beat, cleaner balance sheet.
But the market punished them, probably because of macro fears and that show me skepticism about their aggressive 2026 targets.
The truth is going to lie in the next 2 quarters. It's all about that American national integration and whether those new hires in Dallas and Omaha can actually deliver.
If they do, this dip is a huge buying opportunity. If they stumble, well, the bears were right to pile in.
And that's the game. Thanks for listening to this deep dive on Talk Tickers. As always, do your own diligence, read the filings, and we'll catch you on the next print.
Take care, everyone.